Hello everyone, I'm Ahmed Arif, and in today's video I will provide a very brief overview of efficient market hypothesis, commonly known as EMH. It's quite impossible to cover efficient market hypothesis completely in a very short video, but I will try to do my best. Efficient market hypothesis is also known as efficient market theory. It was propagated by Eugene Fama, a very famous economist. According to this theory, stock market prices reflect all the information. This information might include the information related to the company itself, the economic situation, or the information related to the market situation. And whenever there is a new information coming to the market, prices quickly adjust to this new information. Now this new information follows a random pattern. And when the information is following a random pattern, then the prices, those are adjusted on the basis of this new information, they also show a random walk behavior. According to EMH, all market participants have equal level of information, or in other words, there is no information asymmetry. And when all the market participants have equal level of information, fundamental and technical analysis becomes useless. Nobody can get abnormal returns by using any of these analyses. Now, what does all this mean from an investment point of view? So let's try to understand it with a very simple example. We all know about good versus bad news effect on the stock prices. If there's a good news about sales, profitability, and growth of the firm, then the stock prices are expected to go up. And on the contrary, when there's a bad news associated with sales, profit, or growth of the firm, the stock prices might fall. Now consider the example of ABC company. Mr. John is the CEO of this company, and the accounts department has just submitted the financial statements, and those financial statements are showing that ABC company has performed tremendously during the last year. The profit and sales have shown a huge growth, and Mr. John is very happy about the performance of this company. Now this information is obviously a public information that has to be made public, but it has not yet made public. Rather, John passes on this information to one of his friend John that my company has performed very well. Now Tim knows that once this information is made public, the prices of the ABC company's stocks are likely to go up. So how he will go and make use of such information? He will buy the stock of the company, and eventually when the prices will go up, once the information is made public, he will become rich because the prices have gone up. He bought the share at a cheaper price, and now the share price is very high. Other investors in this situation are at a disadvantage as compared to Tim. Tim had an informational advantage because of the information symmetry in the market, because this market is imperfect market. If we look at the information flow in this particular example, we saw that the information was first passed on to Tim from John, and later on this information was passed on to public. So there was a time gap, and Tim made a use of this time gap, and he became rich. However, under EMH, such a situation will not exist. If a market is perfectly efficient, then this information is transferred to all market participants at the same time. Or in other words, we can say that any information that is generated is instantly transferred to the market, or it is transferred at a super quick rate. Hence, nobody can make a use of informational advantage. So according to EMH, when there is nobody who is having an informational advantage, then stocks are trading at a fair market value. Or in other words, we can say that stock market is operating at its equilibrium. The intrinsic price of the stock is exactly equal to the market price. Hence, there is no possibility of buying an undervalued stock, or there is no possibility of selling a stock at inflated price, because everybody knows that what is the fair market value, and there is no possibility that somebody can outperform the market or get abnormal returns in the market. But then the question arises that if in a perfect market situation nobody is earning very high return, nobody is getting abnormal return, then how an investor can get a very high returns in the market. Is there any possibility, is there any situation in which an investor can earn very high returns? So according to EMH, there is only one situation in which an investor can get high return, and that is by investing into riskier stocks. If there is no investment strategy, there is no technical analysis or fundamental analysis that can help investors to get abnormal returns, or there is no possibility that an investor earns abnormal returns by simply making a smart choice of some stocks, or making the use of timing. This is not possible. The only possibility is that you invest in a riskier stock and then you will get higher returns. If we talk about the informations in the market, there are three types of informations in the market. The first is historical prices of stocks. The second is published information, or in other words, public information, like the information about the sales of the company, profit of the company, assets of the company. The information that is shown in the financial statements of the firm. The third is unpublished information or private information. A very good example of this is that, let's consider a mining company who is involved in the exploration of oil and gas, and company is exploring oil in a very remote location, and company has found that there is a huge reservoir. Now this oil discovery will certainly result into huge cash inflows in the firm, and when the market will have this information, the price of the stock of this company will be skyrocketed. But this is private information, and everybody might not have this information, and especially if the market is not perfectly efficient, then this information is not instantly transferred to the market. On the basis of this information classification, we classify efficient market hypothesis into three categories. The first one is weak form of EMH. According to weak form of EMH, the market participants only have the information about historical stock prices. Now, when everybody has the information about the historical stock prices, then technical analysis becomes useless, because technical analysis is based on the notion that history repeats itself. But when everybody has this information, nobody can make use of it. This information, because this is not a kind of information that is unique to a single individual. Everybody has this information. However, fundamental analysis might be useful in such a situation, because public information that is related to companies' sales, profit, is not readily available, is not instantly transferred to the market. So if somebody has this information, he can make use of such information and conduct some kind of fundamental analysis and predict the stock market prices, and he might earn abnormal profits in this situation. The second form is semi-strong form. In semi-strong form, public information and the information related to historical stock prices is available in the market. Hence, the fundamental analysis also becomes useless in such a situation. So the kind of situation we saw in a John and Tim example will not exist if market is in a semi-strong form, because all the public information is instantly transferred to the market from the company. The third form is strong form of EMH. In this form, all kind of private, public, and stock prices information is available to all market participants. Hence, there is no possibility of abnormal returns, and nobody in the market can outperform the market. So this was a very brief overview of efficient market hypothesis. Thank you very much for listening.